So very quickly, we have 4 topics to cover before we get started, and then I'll begin the presentation. I'm excited. Next month, we'll actually have a guest speaker, which will be wonderful. So with that, let's jump into our 4 items. We've got important items for today. We've got housekeeping. We've got a quick investment update. And then we've got our topic for the month, which is going to be charitable giving strategies. So first and foremost, at the beginning of every call, everybody's muted and their video's off, so that way we can have the presentations. We'll have Q&A at the end. Please make sure to email my email address, william@phillipsfinancialstrategies.com, or lauren@operations@phillipsfinancialstrategies.com with your questions, and we'll try and get them answered while we are doing this. Later, we'll post the call to our YouTube channel. So if you're watching it recorded, you can also email us and reach out with any additional questions. All right. So on to housekeeping. It is tax time. If you still need your tax documents, please let us know. You can reach out. You can get your tax documents. That's 3 ways, by the way, folks. You can reach out to us directly. You can download them from the Wealthscape website, and you can call partner support at 1-866-866-5005. They'll have you do the usual identification questions, and then they'll get you those documents or help you find them on Wealthscape. So that's 3 ways that you can get those accessed. Make sure you download them. Make sure you get them to your accountant. On that same note, it is tax time, so we do still have time to do 2 things. One is fund those IRA accounts. 2 is make an HSA contribution. So you still have time for those, as long as you haven't filed yet and haven't pulled your 1099 from the HSA provider. And then last but not least, I have one quick exciting thing, which is to talk about the fact that we are in the process of rolling out a new Morningstar online login for folks that want to view their regular performance and do a little bit deeper dive into their holdings, whether they're holdings with us or whether they're holdings that are away. And so we're going to be rolling that out and giving you all a notice on how to get your username and password set up. So if you don't hear from us right away, it's okay. I promise we have to go through and do each of these sort of manually. So it's going to take a little bit of time. And we're going to start with the A's and move to the Z's. So the next item on our housekeeping list is we are updating our scheduling practices. We're trying to make things a little bit more formulaic, so that way we don't have a free-for-all for everyone trying to get onto my calendar. Certainly for quarterly and annual meetings, some of the things that we do regularly, as well as just kind of general touch-base stuff. So in order to help make that a little bit easier for everyone, Lauren and Rebecca and Charles are reaching out, and they're configuring some of our back office software to help make it a little bit of a more systematized process. So if they reach out to you about coordinating and scheduling based on some instructions that I've given them, please be helpful in setting up some times when we can meet on a regular basis, or at least have kind of a regular phone call to touch base and make sure that I'm doing the job that you need me to do. And that way I can at least reach out to you and get some of the questions answered that I need to get answered. And if you've got questions, feel welcome to have them set a quick 5 or 10 minute phone call with me, and I'm more than happy to help out. But please, if Lauren and Rebecca and Charles are reaching out about scheduling some things and trying to have you commit to kind of multiple meetings throughout the year, that's the rationale behind it, is that, we looked at our past schedules and, sort of made some determinations about, how frequently some folks like to meet with us. And we want to make sure that obviously we get that time blocked off and that they're not scrambling, trying to find time. So thank you very much for your cooperation and your help as we try and make it a better experience for everybody. On to the next thing. that brings us to an investment update. So the simple, easy answer, pardon me, my camera's down just a little bit. The simple, easy answer behind some of the stuff that we're seeing is that we're seeing a lot of volatility right now. We periodically see a lot of volatility in the marketplace. Obviously, there are some geopolitical events going on. There are a number of other things that are causing the markets to move around, some of which is related to the performance we've seen in the last 2 years from the stock market. And so the key thing to keep your eye on is very simply what the investments are doing relative to your plan. And so we want to make sure if you're working with us, we're keeping plenty of cash for those that are taking withdrawals and making sure that you're able to meet those required minimum distribution items or income needs for your financial plan. So we've got that money set aside appropriately, and we're basically utilizing this time period as a bit of a buying opportunity to go in, make allocations to names maybe that haven't been in the portfolio, or move away from some allocations that have held up really well that maybe now are a little too overpriced. So you will see some trading. It's okay. We're paying attention to it. Obviously, if you've got some questions about the methodology and some of the things that we've gone over before, please feel welcome. Give me a call. Actually, go onto the website, set a meeting invite. That's really one of the best things to do. Also, pinging us through the website or pinging us through an email is really great. So that way we can get on the calendar and I can make sure that your questions get answered in a timely manner, and make sure to address any comments you've got. Next point of note is that I've heard a lot of noise about oil prices and how they've jumped dramatically. We have seen some of this before. And so the thing is that what you want to basically just do is really just kind of let history be your guide. We saw this in 2008. We've seen this at other points in time. And so very simply, pay attention to what commodity prices are doing, pay attention to some of those kinds of things. If you've got concerns, give us a call. But frankly, any kind of idea that this will persist forever is probably not going to be the case. Yes, there's going to be some pain. These things, economies move through cycles. Things move through cycles. The reality is that some cycles are longer than others. Most of these kinds of cycles that we're seeing right now typically last about 18 to 24 months. And so we can expect that things will be moving around quite a bit for about 18 to 24 months before they settle back down. This is all, in many cases, par for the course. There are some things we want to just obviously pay attention to, whether they represent opportunities or trouble ahead. And so we plan accordingly. It's why we create a plan. It's why we sort of game these things out well in advance. So that way, when the events happen, we're not scrambling, worried, trying to make a plan. It's that we already know what to do. And so we pay attention to the news, we do the thing that we need to do, and we carry on with our lives. And that's kind of the gist of it. So that brings us to our topic of the month. But before I come to the topic of the month, I do want to take a quick moment and address kind of a conversation that I had with some of my colleagues while at a financial planning conference last week. We were actually talking about what it means to kind of do what we do. And, this difference between sort of fiduciaries and non-fiduciaries and recommendations and planning, and how do you know you're sort of working with the right person, especially with a specialized topic like charitable giving. The reality is that you need to be having a conversation with someone that is able to address your needs, and also someone that either is engaged in charitable giving or can walk you through all of the various kinds of charitable giving that you've got. And I'm going to address a number of them today. But the important part to sort of understand is that while credentials are important, they're not everything. And more importantly, the person that you might be working with, you want to ask obviously basic questions about how independent they are. I, a long time ago, was at another institution. Many of my colleagues were other institutions, and part of our debate, part of our discussion were, if you're not independent and you're only able to work with a specific company and a specific product set, how much of an actual fiduciary would you be to recommend the best thing for a client if your paycheck was dependent on it, or if you only had access to that one or two thing. And so it sort of brings up that old phrase about how if you're a hammer, everything looks like a nail. And so I thought that was interesting, and it was something that I wanted to kind of bring up before our call, because the simple fact is that we're going to talk about a variety of things today and cover a number of things on the call in the next 15 minutes. But if you're not working with somebody who's kind of independent and doing the work across platform, then maybe that person is missing big opportunities for you and your planning. And with that, let's get into some specialized planning, and let's talk charitable gifting for a moment. And so to make a bit of that easy, I'm actually going to pull up my crib notes, and we're going to walk through them real quick on a screen share. So we'll make some of this stuff available as we kind of go through it. But biggest thing, let's start at the top. Let's talk about the various ways that we can give. What are the kinds of things that we can give when we talk about charitable giving? Because a number of folks walk into my office and they say, well, I want to give all these various gifts, but, where do I start? What can I do? How does it, save on my taxes? So here's a couple of quick things about some of the various ways to give. Who can you give to? Well, you can really give to anyone. The question is, maybe, is it tax deductible? Is it not tax deductible? And here's the thing, is that in order for the gift that you give to be tax deductible, it really needs to go to a registered 501c3 organization. I use a great website when I look at stuff, and this is from my nonprofit days. And for those that don't know, I started out in the nonprofit world working for a nonprofit downtown that was affiliated with White House. I did a lot of work through the Park Service and through the curator's office on the museum side. So, the thing is, registered 501c3. That's really important. That is based here in the U.S., that has a U.S. nexus. So if you want to send money to an El Salvadorian-based 501c3 that you heard about from your cousin, you may not get a tax deduction for it unless they're registered here stateside. So that's important to keep in mind when you're giving and how much you give. The other thing is that there are limits associated to the amount that you give each year, either relative to your gross income or they're relative to the person or entity you're giving them to. So the thing is that we want to touch base with your accountant. We want to make sure that we are aware of how much money you're giving away and to whom, so that way you can still get the full value for those contributions, and not just to have some warm and fuzzies out of the deal. And though I'm not discounting warm and fuzzies, and we'll get into that here in a second with what's on the screen. So some of the popular things, some of the stuff that comes across my desk in our office, and some of the things that we help facilitate on a regular basis, those end of year planning drives from all the 501c3s. It seems like you can't open your mail starting around Veterans Day through to the end of the year, discussing folks' planned giving. One of the big things, and this is something we do here at the office, I'm a big fan of, is Giving Tuesday. That is when I will make the charitable donation to Humane Rescue Alliance, Gearing Up Bicycles, as part of our annual holiday gifting program. The other thing is just keep in mind, various fund drives happen throughout the year. I know here in DC, NPR is very popular, as well as various philanthropic and secular organizations, non-secular organizations as well. Before I get into charitable contributions, I want to take a quick jump ahead, and I want to say the IRS actually has a mini course about making sure you can deduct your charitable. If you have a lot of charitable inclinations, my advice is to go take 10 or 15 minutes, sit through this little webinar presentation that the IRS has created. It's really effective and it's eye-opening. Here's the URL. We'll make sure that we share the URL for anybody who wants it. But it's important, especially if you have a lot of charitable aspirations. I have a large number of them. I will say that right now. I have legacy plan gifts, both at George Washington University, my alma mater, for my graduate school. I have some planned gifts for Swanee, where I got my undergrad, as well as at Humane Rescue Alliance as well. So and so I've done a fair amount of planning already for my own estate. And so that said, I look like a kind of a youngster. It's okay to plan early. It's perfectly fine to do. And how do we do that? We can do that through a variety of ways. Most commonly, in terms of these things, is qualified charitable contributions. Now, qualified charitable contributions are when you take money from an IRA, pre-tax account, and instead of your required minimum distributions, you donate that money to charity. Now, there is, with the IRS changes to the required minimum distributions rule, there is currently a slight disjoint. So starting at age 70 and a half, you can begin making qualified charitable contributions, but you don't have to start taking RMDs until the tax year in which you turn age 72. So that's key, because you could potentially have 2 tax years there to help lower your potential required minimum distribution requirements. And the way these qualified charitable contributions work is that what you can do is you can take the money that would be for your required minimum distribution, would be income, instead of realizing it as income, perhaps bumping you into a high tax bracket or something along those lines, is that you can send the money directly to the charity. And that's good for a variety of reasons, one of which is that it doesn't raise your taxable income relative to your Social Security, which for certain people is really important, because yes, depending on how much money you make in terms of income, your Social Security can become taxable. And other things can perhaps maybe not become taxable, like certain medical expenses. So this is a key item to keep an eye on. Again, I recommend if you're working with us, we always ask questions and coordinate with accountants. If you're not working with us, make sure you're coordinating with your planner and your accountant. If you're doing your own planning, or you're doing your own taxes, make sure you coordinate, check with the IRS, we get the math correct before you accidentally disqualify stuff. And more on qualified charitable contributions, you've got this publication here, which we'll also make available. Next, I want to touch on legacy planning, because I did talk about legacy planning a little bit. So what is really common in my world is we see folks that read up and they hear about these charitable remainder trusts or these charitable remainder annuity trusts. This is a really great way to give if you've got real legacy aspirations. Now, the way that these particular items work is that you can move money into this type of trust. It gets it out of your estate if you live in an area where, or if you have a sizable estate where estate taxes might be needed. But more importantly, if you have legacy aspirations and you want to give a portion of your estate directly to charity and you don't want it to pass through probate, you can set up one of these trusts. You take withdrawals and receive income throughout your life, and then whatever remains, hence the remainder part, you donate directly to charity. So there's a way to do this straightforward with a straightforward sort of charitable remainder trust, where you put the money in, it grows, does its thing, you take income, remainder any dollars left go right to charity. There's also the charitable remainder annuity trust. This is called a CRAT. You'll see oftentimes folks refer to it that. So you have CRT, you have CRAT. This CRAT is charitable remainder annuity trust. Basically, you make a donation to a charity. They agree to give you lifetime income from the asset over a period of time. And what remains they keep. There are actually some published annuity rates regarding this. I will tell you this, they're not too common. As folks have been living longer, it's not necessarily kind of been the most efficient thing. And charities bear some risk, if you live a long time, of potentially paying out more than the value of what you donated. So some of the charities have kind of shied away from this. I will tell you this, there are some annuity companies out there right now that do make a product that allows you to get the same sort of function. And so you make a contribution to an annuity, you receive your lifetime income. At the end of that, the money can be directly sent to the charity, or in some cases, they have a rider where the initial dollars that you put in are guaranteed as a payout to the annuity, so to the charity of your choosing. So, for example, you could put in $100,000, you could get your lifetime income that's set, and let's say that account balance was $5,000 or something, because you lived a very long time. The rider that you paid for would come in and would make the account whole to the $100,000 you initially put in, and then that would just go off to the charity. So there are all kinds of things that you can do here from a legacy trust planning situation. The same is true with lifetime gifts and pledges. And a lifetime gift or a pledge is basically pretty straightforward. If you have a plan giving office with a charity that's particularly larger, oftentimes you can agree that you will pay them, $10,000 or $15,000 over a period of several years. And that's where some of these lifetime gifts come in. And you'll see oftentimes, particularly at universities, they give you access to specific clubs or specific events, and because you're making these things where they put your name on a plaque outside of a door, that sort of thing. The other thing that we'll get into is also life insurance. Life insurance can be kind of efficient. We're going to talk a little bit more about that in a few minutes. This is the other thing that's particularly popular, by the way, is education. We talk about gifts to children and heirs. Hey, I want to make sure my children are okay, or I want to help out with grandchildren. I want to do some stuff, but what do I do? How do I do it? Can I give them some money? I will tell you the most efficient way, some of the ways that we've seen this and beneficial, is through education funding. So one of the things that you can do actually in order to take some of the deductions in your gifting is that if you just call me up and I liquidate some securities and you write a check to your kids or your grandkids, and then they spend the money in college. So that's a taxable event to you, and it's an issue. But if you reach out to the cashiering office at the university or the educational institution, and you either donate the appreciated security directly to them to cash and deposit. By the way, most universities have the function and capability to accept that, or the check goes simply straight to them. You can count that as charitable contribution. There'll be a deduction that you can take on your taxes. That's the right way to do these kinds of things, is to have that money go directly to the institution and not to the child, or not to the grandchild or child, or the private entity. And that's particularly important. We can work with you on that and all the particular details. So if you want to talk more about it, give us a call. We'll make sure that we get that squared away for you. The other thing is, next on the list here is private family foundations. These are common. I will tell you, from my nonprofit world, from the volunteering work that I've done, we've spent plenty of time dealing with private family foundations in terms of soliciting grant money, various other stuff. These are really great, and I am happy to make use of them. Please reach out to me if you want to set one up. I will tell you that they have some really specific rules associated with them. So this can be an administrative item. So you want to make sure you've got other folks supporting you and helping you, because what you don't want to do is violate the rules associated with a private family foundation. And again, I emphasize the IRS has some specific rules regarding them. Read up on them, so that way you're advised. If you're not working with us, you're doing your own thing, please read those rules. You do not want to break the rules when it comes to the IRS. Next, donor advised funds. These are really great. They're efficient. They've been in the news a little bit lately. It's kind of like a private family foundation. It's got some of the rules, but it's a bit more flexible. And there are a number of investment companies that offer these donor advised funds. If your account's large enough and you're going to do some stuff, you can actually set up your own donor advised fund. We can work with your attorney on how to do that. But basically it requires establishing your own 501c3, and then kind of moving from there. But one of the nice things about the donor advised fund is that the charity itself is revocable. So if you haven't identified the charity, but you want to give, you can utilize the donor advised fund. If you think a handful of charities, but you're not going to disperse the money for another 30 years, again, it's revocable. If you change your mind and you want to work with another institution, you can do that. You've got a little more flexibility. These private family foundations, you've got to get 5% out every year, kind of restrictive. These trusts, the charitable remainder trusts, and these CRATs, once you pick the entity, that's the entity. It's irrevocable. So that's important, or irrevocable, tomato, but you get the idea. Next, let's dive into appreciated securities real quick for just a quick moment. We donate a fair number of appreciated securities every year to people like NPR and various charitable organizations here in Capitol Hill. Everything Bread from the People, you name it. So here's one of the exercises that I go through behind the scenes when clients call me up and they say, hey, I want to donate, XYZ, can you name some securities? What should we do? So one of the things that I always look at is what the cost basis is. What did you purchase the thing for? I want to have an idea of what your effective tax bracket is and take a look at what the gains are. Because what I'm looking at here is this formula. So I want to know that what you're donating, your tax bracket, your tax deduction is basically going to be greater than the amount that you purchased the security for. That's the goal behind the exercise. And so, the simple formula, really quick and easy, is your cost basis divided by your tax bracket gives us what the gain should be for the security in order to be our minimum threshold. So in this case, for this example, if I bought a certain stock for $1,000 and I was going to donate it, and my tax bracket was 25% in terms of my effective tax bracket, which I would get from my accountant, or the cover page on like a TurboTax, if you use that, I would expect that the value of what I was donating was greater than $4,000. So if it was only $3,500, I'm still going to get a little bit of a tax break, but I'm also going to have kind of more of a warm and fuzzy, as opposed to an economic benefit from making that change. And if you've purchased securities in the last several years because we've had good markets, there's a strong possibility you've got some things in your portfolio that have over a 400% gain. So, and obviously, if your tax bracket's higher, the amount of gain that you need is much lower. So if you're in a 33% effective tax bracket, you only need a 300% gain. If you've got questions about the math, give me a shout. I'll get on my calculator and we'll go through it. Next, life insurance. For those of you that know me for a long time, I did cut my teeth in the life insurance world. I probably know more about life insurance than the average bear, or maybe more than I should, one or the other. So by and large, first rule that they teach you in life insurance school is that life insurance premiums are not tax deductible. However, I'm going to tell you today that life insurance premiums actually can be tax deductible, and I'm going to tell you how. And that is with charitable giving. And I mentioned up here legacy planning. So here's what happens. Very simply, if there's a charity where you have a charitable interest, for example, Humane Rescue Alliance, I've worked with them, worked with a number of folks. This is my own personal stuff, by the way. I'm not endorsing. So if anybody from the Rescue Alliance calls me up, just want to clarify that for the purpose of this. So in my own personal situation, what I have done is I have donated a life insurance policy to the organization, and I make donations to cover the cost of the premium, so that way the organization has no costs. So when eventually I'm no longer with us, they will have a very nice life insurance payout, and they will not go out of pocket for the life insurance for the premiums. And the donations that I make are in fact tax deductible because I am making a donation to cover the cost of the premium for the life insurance policy, and the donation is being made to the 501c, to the registered US-based 501c3. All of those things very important. Now, one of the key things about this, there are two pieces, and I want to emphasize this very quickly so that way no one feels like there's an endorsement being made here. First and foremost, your planner or your agent should be able to provide you with an internal rate of return calculation. And this calculation is going to tell you whether or not it is better for you to just simply give money to the organization so they can do what they want with it, or if it is better for you to perhaps go through the process of being underwritten by a life insurance company. The specific annualized rate of return that we're looking at is right around your life expectancy. So, for example, in that internal rate of return report, if you're really healthy, you might have a rate of return above 5, 6, 7%. If you're not so healthy, your annualized rate of return might be like 1%, or it might be negative. In that case, probably maybe a life insurance policy in doing this process isn't effective, plain and simple. And so, but work with your planner, work with your life insurance agent, work with the organization, and, if the numbers work out, this can be very effective and very efficient. Next on the process, let's talk about cash. A lot of times folks have cash. If you're currently working, you're in the federal government, I believe it's an FCC number. You can have money go straight through an employer program. There's a number of organizations and number of companies here in DC where it's literally charitable giving is part of regular cash flow. Like you have the opportunity to do it right from your paycheck. So the money doesn't even go to your bank account. I always tell my clients, and I always advise them, take advantage of things like Giving Tuesday, pledge drives, matching campaigns. These things happen throughout the year, particularly with big organizations. I mentioned Charity Navigator earlier. And so a lot of times you can use that to A, rate the institution, but B, sometimes find out when they have these regular drives and maximize those dollars that you give. Not just for the warm and fuzzy, but more importantly, maximize it for the organization. Because if the organization has to, and I used to do this when I was on the board of an organization, we would always have these, they would always have these call drives. And so, I'd always, bike pizza and hang out with them. While we called all of our donors because we had some other donor that wanted to match funds if we raised, $5,000 on a Tuesday night. And so that's a great way to maximize. And so just be cognizant of it. And, again, we can sort of help you with how it is that you want to structure that, who you want to talk to with their office. And that's really through my experience in working with nonprofits, both being on the board of them and, my prior career. The other thing, it's not really tax deductible, but it's great on the warm and fuzzy side, time and energy. Giving your time and your energy, knowledge and expertise is really important. A lot of these nonprofits are oftentimes, they have trouble with, short staff, getting talented people through the doors because they can't afford to pay competitive salaries. So if you've got a special set of skills, that might be useful to the organization, they would absolutely love to have somebody in. And I know a couple of nonprofits where, heck, they'd be happy if you showed up and pushed a broom on a Saturday for an hour, because they need the help. And so, you can get into everything from folks like Anacostia Riverkeepers and whatnot in the Watershed Society that are conducting, high-level scientific experiments, all the way through to, people that would love for you to show up and, basically push a broom. Last thing, things. Comic books, collectibles, vehicles. We hear it all in my world. I will tell you this very quickly. You can most definitely donate things. The IRS has a very specific schedule for what's deductible and the amount thereof in its condition. High dollar value things that are donated have to be appraised and passed along. There's a whole very specific process. So if you were going to donate a photographic collection or a book collection to someplace like the Library of Congress, it has to be appraised, it has to be sorted. Oftentimes you have to make a monetary gift for the cataloging of said collection and maintenance and integration into their records. So, we can talk about it in more detail. But again, the IRS has a really specific and set schedule related to these things. That is basically it for my crib notes, and I hope it gives everybody a good primer about what to focus on, what to think about as we go through kind of the idea of charitable giving, things that you can set up, things that you can do. If you're working with someone that has a lot of knowledge and has a working understanding of the field and what nonprofits want and what is available from the charity perspective, you can really maximize your dollars. The other thing to do is don't be shy about just simply reaching out to the organization. A lot of those places have giving offices, and you can work directly with giving director. So with that, I've concluded my part of the presentation. I'm going to open it up for some Q&A, and I'm going to check my email, and I'm going to see about checking Lauren's email, and we're going to see what we've got. So with that, all right, going once, going twice. All right, I do not have any questions on my end. And with that, it's time to end. We're right at 5:45, so we've been here 40 minutes, which is what I promised everybody. So if you've got questions, if you liked it, leave some comments, reach out to us, share some things. We're always happy to hear it. Again, I hope you found this informative from a planning perspective and it gave you a lot of food for thought. Until next time, we'll bid you adieu. Have a great day, everybody. Bye-bye.